Let's imagine you're on a game show and have just won $500 in the first round. As you spin the wheel, you land on the bonus space, and the host presents you with a choice. You can either take a guaranteed $100 bonus, or you can roll a dice. If it lands on 1 or 2, you'll win $200. But if it lands on 3, 4, 5, or 6, you'll get nothing. Later in the game, you've won a total of $1,500 and land on the penalty space. The host offers you a choice. You can either take a $300 loss or roll the dice again. If it lands on 1 or 2, you'll break even. But if it lands on 3, 4, 5, or 6, you'll lose $500. Most people would choose to take the guaranteed bonus in the first round and roll the dice in the second round. However, if you think about it, the odds and outcomes in both rounds are exactly the same. The reason the second round seems scarier is due to a cognitive bias known as loss aversion. Under rational economic theory, our decisions should follow a simple mathematical equation that weighs the level of risk against the amount at stake. However, studies have shown that for many people, the negative psychological impact of losing something is about twice as strong as the positive impact of gaining the same thing. This is loss aversion, one of many cognitive biases that arises from heuristics, problem-solving approaches based on intuition. Heuristics can lead to irrational decisions, such as logical fallacies that can easily be proven wrong. Situations involving probability are notoriously bad for applying heuristics. For instance, say you were to roll a dice with 2 green faces and 4 red faces 20 times. You can choose one of the following sequences of rolls, and if it shows up, you'll win $10,000. Which would you pick? In one study, 75% of the participants chose the longer sequence, even though the shorter one was more likely. This is an example of a conjunction fallacy, where our brains trick us into picking the less likely option. Heuristics are also terrible at dealing with numbers in general. In one example, students were split into 2 groups. The first group was asked whether Mahatma Gandhi died before or after age 25, while the second was asked whether he died before or after age 120. Both numbers were obviously way off, but when the students were then asked to guess the actual age at which he died, the first group's answers averaged to 70, while the second group's averaged to 83. While heuristics can sometimes save our lives when we need to make quick decisions with limited information, today's complex decision-making requires more careful analysis. Unconscious biases can affect everything from health and education to finance and criminal justice. To combat these biases, we can learn to be aware of them and pause for a second to consider that the intuitive answer might not always be the right one. Welcome to the Wealthy Map, where we help you navigate the path to wealth and prosperity. In today's video, we'll be exploring the fascinating topic of the psychology of money and how it can impact our decisions. Money is an important aspect of our lives, and understanding how our beliefs, emotions, and biases influence our monetary choices is crucial to achieving financial freedom. By examining the psychology of money, we can gain a deeper understanding of our behavior and make better monetary decisions. So, let's dive into the world of the psychology of money and explore how it affects our personal finances. For instance, studies have shown that our emotions and cognitive biases can influence our investment decisions. Overconfidence, loss aversion, and the herd mentality are just a few examples of the biases that can impact our investment choices and ultimately our wealth. Emotions play a vital role in our financial decisions. They can influence our choices, sometimes leading us to make irrational decisions. For instance, many people may have felt the fear of missing out, FOMO, and invested in cryptocurrencies like Bitcoin without properly researching the market. According to a survey conducted by Finder, a financial research firm, approximately 1 in 5 Americans have invested in cryptocurrencies, with almost 60% citing FOMO as their reason for doing so. However, cryptocurrencies are extremely volatile, and investing in them without proper research can lead to significant losses. Similarly, greed can influence our financial decisions. For example, some people may be tempted to invest in a hot stock, hoping to make quick profits, without considering the underlying fundamentals of the company. This can result in significant losses if the stock price eventually falls. On the other hand, overconfidence can cause people to ignore warning signs and make risky investments. A study by the University of California, Berkeley found that overconfident investors tend to trade more frequently and have lower returns than their less confident counterparts. managing our emotions is essential to making better financial decisions. For instance, setting realistic expectations can help us avoid chasing unrealistic returns. Creating a diversified investment portfolio can also help mitigate the risks associated with emotional investing. Overall, emotions can have a significant impact on our financial decisions. By recognizing and managing them, we can make more rational choices that align with our long-term goals. Cognitive biases are patterns of thinking that can cause us to make irrational judgments and decisions. These biases are often rooted in our personal experiences, beliefs, and values, and can significantly impact our financial choices. One example of a cognitive bias is confirmation bias, where we tend to seek out information that confirms our existing beliefs and ignore information that contradicts them. For instance, if we believe that a certain investment is a good choice, we might only look for information that supports that belief and ignore any negative information that may challenge it. Another example is hindsight bias, where we tend to believe that we could have predicted an event's outcome after it has already occurred. This can lead us to make financial decisions based on false confidence and overestimate our abilities to predict the future. Lastly, anchoring bias occurs when we rely too heavily on the first piece of information we receive when making a decision, even if it is not relevant or accurate. For example, we might base the value of a stock on its initial price without considering other relevant factors. Recognizing these biases and learning to overcome them can help us make more rational and informed financial decisions. It's important to approach financial decisions with an open mind and gather as much relevant information as possible before making a choice. Social influences can greatly impact our financial decision-making process, and it's important to understand how these factors can affect our choices. According to a survey conducted by Credit Karma, 39% of millennials reported feeling pressured to keep up with their friends' spending habits. This peer pressure can lead to overspending and debt accumulation, as individuals try to keep up with a lifestyle that may not be financially sustainable. Social norms can also influence our investment decisions. For example, during the dot-com bubble of the late 1990s, many people were investing in internet-related stocks because it was the popular thing to do, rather than based on sound financial analysis. As a result, many of these investments ended up being overvalued and eventually crashed. Cultural values can also play a significant role in our financial choices. In some cultures, there is a greater emphasis on saving and frugality, which can lead to more conservative investment strategies. On the other hand, cultures that value risk-taking and investment may be more likely to take on riskier investments. For instance, in the United States, the culture of consumerism and materialism can lead to excessive spending and debt accumulation. This is reflected in the fact that the average credit card debt per household in the U.S. is $7,527, according to a study by Experian. By recognizing and understanding the impact of social influences on our financial choices, we can make more informed decisions that align with our own values and goals. This means being mindful of peer pressure, social norms, and cultural values, and making decisions based on what is best for our financial well-being. Personal values and goals play a crucial role in our financial decisions. For instance, someone who values experiences over material possessions may choose to travel frequently and spend money on experiences rather than save for a luxurious car or a big house. Similarly, someone who values financial security may prioritize saving for retirement over indulging in expensive purchases. However, sometimes our personal values and goals may contradict our financial objectives, leading to irrational financial decisions. For example, someone may prioritize living in an expensive apartment in a trendy neighborhood, even if it means sacrificing savings and living paycheck to paycheck. To make rational financial choices, it is important to align our personal values and goals with our financial objectives. This requires self-reflection and introspection to understand our values and long-term goals. Once we have a clear understanding of our personal values and goals, we can make more informed financial decisions that support our objectives. In conclusion, understanding our personal values and goals and aligning them with our financial decisions can help us make more rational and informed choices that support our long-term objectives. Good money management practices are essential for making rational decisions regarding our personal finances. Habits are patterns of behavior that we learn and repeat over time until they become automatic. Our daily money habits can have a significant impact on our overall financial situation. On the other hand, bad money management habits, such as overspending or neglecting to budget, can lead to a cycle of debt and financial strain. In conclusion, the psychology of money plays a significant role in our financial decision-making. Emotions, cognitive biases, social influences, personal values and goals, and habits can all affect our financial choices. By recognizing and understanding these factors, we can make more rational financial decisions and improve our financial outcomes. It's important for you to reflect on your own behaviors and biases and make changes to improve your financial habits. This could involve setting financial goals, developing a budget, and building good financial habits. Ultimately, by understanding the psychology of money, you can take control of your finances and make better choices for your future.